All right, so we're going to talk more home sales today, which I'm really excited because we're going to get kind of into the crystal ball conversations today. Let's get some people excited about the burning up the homes.
Get
the home
excited
market
about a
again.
6% rate.
No, 5%. Can we hear 4?
Can we get 5?
Can we get a 4? So before we jump
Reverse auction.
Before we jump, I wish I could do that.
Yeah.
Hit subscribe if you like the show. We'd love for you to do that. Jonathan Ramirez here. Going to be talking interest rates today on the show. The Fed's cut rates by how much?
Quarter of a point.
Quarter of a point.
Woo!
Yeah.
Everything just went on sale. So first of all, what kind of impact that going to have on the housing market? And then secondly, we'll dig into where do you think future interest rates are going to go?
Yeah. Well, thank you guys again for having me, and it's always a pleasure to sit down and chat. One of the biggest misconceptions I think between the federal funds rate and mortgage rates is that when the Fed drops rates, that it instantly impacts mortgage rates, and that's just they kind of run in the same river, but they don't get impacted at the very same time, right? The Fed meets 8 times a year. They make decisions based on econ reports and some activity in the market, but they're typically judging the market through the rear view mirror, right? And mortgage rates move in real time. They follow bond markets that are trading throughout the day. And so mortgage rates come out daily and sometimes will shift during the day based on the activity happening in the bond market. So they're very different in that regard. For example, when that September 5th jobs report came out, rates instantly plummeted because we went from about a 90% chance of a rate cut to a 100% chance of a rate cut. It was just a matter of how much. We started seeing rates dropping for that 2-week period before the September 18th announcement. And by the time the Fed announced it, pricing was already baked in. We already had the lowest rates we had seen in over a year. And those are the best times to strike because it's before the dust begins to, fly up and you have all the different volatility factors playing a role into it. Because once the announcement happens, then it turns into what's going to happen in the future. And were they right or were they wrong?
All right, now let's move again.
Yeah. all of the speculation then kind of comes to a head. Well, we thought they were going to say this, but they said that. Or we only expected this, but now this happened. And so, that's what moves the markets after that rate.
That's just like an earnings call.
Yes.
It's like man. The week or the leading up to, an Apple or an Nvidia or whatever, they all gather, and we're like, all right, the price is going to do this because we think it's going to come back this. And then the day of the announcement, it's like, either an implosion because they got it all wrong or it was a penny off.
Right. Yes. That's my favorite is whenever they're like record, the most income, like
ever.
Net profit they've ever had. But this one little minute number was off by a penny. And you're like, what?
And the stock goes down 9%.
Yes. You're like, what in the world?
What just happened?
Yeah.
And like we're expecting 0.25% and it was, a little bit less,
24.24.
And now rates jump a half point.
That's right.
Like what?
Yeah, that's exactly right. And we see that in our world all the time. In fact, here we are about a week outside of the rate cut and today's rates are about not quite to where we were before September 5th jobs report, but we're nearing that same level.
Really? So it's already crept.
It's already crept a little bit higher, but still rates are hovering kind of in the low 6s. So between 6.3 to 6.5, which is a great place to be right now compared to where we have been for the better part of the last.
Okay, so how many opportunities do the Feds have between now and the rest of the year to cut rates?
We've got 2 more meetings, so we're pretty much expecting a couple of more rate cuts. At least that's what Wall Street has baked in. That's what the bond market has in terms of expectations. So if something were to change around that, I could see rates going up pretty quickly. Yeah. But as long as the rate cuts are expected to continue, right now, that's already baked into pricing. So you don't need to wait until October. You don't need to wait until December. The bond market already expects a couple of rate cuts between now and then. And then
So you're almost in a worse scenario if you're waiting for those announcements and something deviates,
Right.
and they say something different or don't change it,
Well,
then you're going to see that
well,
spike.
hold on a second. So you're saying if the Feds cut rates 2 more times, rates will not go down?
They will begin to follow the downward pattern, but they're not 1-to-1. If the Fed announces another quarter of a point, we're not going to see rates go from 6.5 to 6.25.
The anticipation gets more of a hit than the actual.
Right, exactly. So we'll start to ease into that, and really it'll be more around the dates where you see CPI drop, your inflation report or your jobs report, consumer sentiment. All of these reports that come out are the ones that tend to move the bonds market more than the actual Fed meeting. So, because they're what the Fed is looking for.
Well, I'm just done with this. This is stupid. Like, that does not even compute
I
in
know.
my mind.
Yeah.
Well, we're in a real market, right? The Fed's job is to look at previous data, whereas, all of us sitting here, we're looking at what's happening today. We're looking through the windshield, not the rear view mirror. And we can
Right, 'cause
see
you
what's
got to make
already
a bet on that 15, 30-year mortgage, right?
Yeah. So what's going to happen now? Where are we right now, as opposed to looking at last month's data? And so when those reports come out, it gives us real-time indicators and mile markers into what the expectation is moving forward. So
What's fun about this conversation? This has got to be what a client feels like when we're talking about dividends.
Right.
Because you're sitting over there like super confident, like this is how it works.
Yeah.
Like,
What do
and
you
I'm sitting
mean?
over like, what are you talking about? That's not what I know.
Right.
And that's got to be when we're sitting in front of a client, we're talking about dividend, like look at this, look at this, look at this. And there's like, what are you talking about? That's not what I hear on TV. That's not what I understand when I read online.
It's all growth,
Because
growth,
everything
growth,
that you're
growth.
saying right now is almost completely contradictory to what I understand about rate movements.
Right. Yeah, because the Fed moves
So is this fake
overnight.
news? Am I getting punked right now? Like what's going on?
They're just two different markets. And
So clarify that. When the Fed sets a rate, what does that rate actually impact?
Good question. It's the overnight lending rate. So if you have a home equity line of credit, if you have any sort of variable interest rate, like on your credit card or any sort of revolving debt, those are typical debt instruments that literally that same day or that next day would change in terms of a rate. It would go, if it was September 18th was, 7.5, September 19th would have then been 7.25. That's an instant change. So typically any sort of variable rate environment. However, when you have a fixed rate component and the mortgage space that kind of works off of a bond market, it plays in a slightly separate sandbox that has the same kind of sand in it.
Sure.
So it's a little bit, they'll eventually kind of intersect and meet, but you'll see the mortgage markets react much faster.
Yeah, I learned something.
Yeah.
I don't like this conversation anymore.
Well, some good news there is that I'll tell you, if based on the projections, if rates were to hold steady from now throughout the end of the year.
If the Feds cut rates 2 more times, I know what you're saying is blowing my mind right now, but if they cut rates 2 more times and interest rates go up, you're going to have a very interesting housing market. That is going to be very bad for the housing
Or
market.
even just stay the same, right?
Yeah.
Like he's saying that we've kind of already got it baked in.
Right.
So you're not really going to see a ton of movement.
It can't be baked in because we don't know.
Welcome to September 2024. So, this is what happened last year. If you guys remember, the Fed dropped rates. Everyone expected a quarter. They dropped it by half of a point in September. In October, they dropped it another quarter. In December, they dropped another quarter. So there's a 1-point drop in the fourth quarter of last year. Rates dipped for about a 3-week window, and then they shot up almost back up to 7.5% or north of that.
Why?
Well,
I'm
we
getting
just
mad.
had an
I'm
election.
getting mad right now. What is going on?
We had just had an election, and a lot of the administration's policy was around shoring up some labor in immigration and tariffs, which were inflationary in nature. And there's a third component in there that I'm blanking on, but that really spooked the Fed. Now, all of a sudden, this is what we've been dealing with in 2025. They're used to looking through the rearview mirror, but this year specifically, they're all of a sudden saying, oh, wait, no, we're worried about the future. This has never been a Fed thing. They've never worried about the future. They've always been looking in the past, because they have two jobs, right? They need to keep inflation down, and they need to spur job growth and the economy to grow. And they do that based on what they're seeing in previous data. But this year they're saying, oh, well, we don't know what's going to happen with tariffs. We don't know what's going to happen with labor shortages.
They did this just before the election.
Right. So when that started happening, rates shot back up and literally went up about 1 full percent after the Fed dropped rates by 1%. And that's welcome to my world. I was expecting 2025 to be a really
like
good year.
gangbusters, and you're like, wait a second.
You should look at my goal setting from this time last year. I mean, I was really ready to get back on.
You know what this is like? This is, I don't want to keep connecting this back to stocks, but I can't
this
stop.
This is what we do, yeah.
Like when you look at a balance sheet of a company, especially a company that's on like the S&P 500 or in the top 1,000 companies on the NASDAQ, what you normally see year over year is tons of extra profit. Like very seldom do you see an actual company go backward. And yet stocks, like if you look in 2022, you look in the beginning of 2020, you look at 2018, you look in 2008, you can even go back to 2000, 2001, 2002, and you can find more companies that set records.
Yeah.
Like Amazon. Like if I went through the statistics of Amazon and how much money they made from 97, 98, 99, 2000, 2001, 2002, like they were they were breaking barriers of how much money they were making, and their stock lost like 80%.
Yep. Because they didn't how they were reinvesting their money.
But regardless, the company was cleaning up debt, taking charge of, they were setting the foundation of where they are today. And yet their stock got crushed. And actually we had a show about that years ago where I'm like, let me read you some actual financials of what happened. And I didn't give the years. I'm like, here's what happened. And I was like, what do you think the stock price did? And it was like 50%, 30%, 40%. Yeah. And the stock, the profitability of the company just went like this. And that's all I hear from you is like, the government's doing this. Yeah. And then your rates are doing the banks. And this is what ticks me off in this business is like, we get a bad rap sometimes. Like you're getting a bad rap. Like, why are rates going up, man? Right. What's your problem, Jonathan?
Why can't you give me a better rate?
Yeah. Like why'd you put me in this stock? Have you looked at their financials? That the stocks in our portfolio are crushing it. They might not hit every single facet that we might look at, but long-term it's doing great. And you look at the economy, you look at things that are going around, things are going great. Yeah. You might hate who's in charge, you might love who's in charge, but we're on a track for success.
Right.
So with all that being said, sorry for my rant there. let's give our listeners some excitement. Let's put your prediction hat on. Right. Where are house prices going to go? Where interest rates, like let's go a year out. Where do you think interest rates are going to be?
Let's give you a redo on that goal setting from last September.
And even still, like if I've got the opportunity to go buy an awesome house, like do I bite the bullet and do I believe rates? I would never ever suggest you buy a house you can't afford. Right. But if you could squeeze, like cut a vacation out or two or something like that,
you just realign your priorities.
Can you realign your priorities? Yep. Is it make sense to go do that because it's for sale and this is your one shot to go get it, negotiate, use the economy to your advantage right now, and then our rate's going to be lower, and we're going to hold you to whatever you say right now. So where are we going?
All right. Well, I don't know if I should be held to this, but here's where I think.
We get held to our standard, so we're holding you.
If rates were to continue to hover where we are now in the low to mid sixes, I think we'll see about a 10 to 15% jump in home sales for this upcoming quarter, for the fourth quarter of the year. Now that's really rare to have a double-digit jump in a single quarter
because rates are coming down.
If that happens, that's a really good thing for.
What do you mean if?
Well, I mean,
I want some confidence here.
We should expect it. That's what I expect. I expect a really busy fourth quarter because of where the market is currently, based on the most recent Fed decision, but then also because of the Fed's predictions, right? So what they've already put on the dot map, and right now, I mean, you don't have to wait a year, but right now we're at all-time high, a 5-year high for inventory and a 1-year low for mortgage rates. So when you say, all right, right now in the last 5 years, right now you've got more inventory than you've seen in the last 5 years, and we also have a 1 year drop, the lowest rates we're seeing in the most recent 1 year period. This makes it a very opportune time to get in there and be part of that 10%. You know, because like I said, the market is just primed to pop right now.
Yep.
I think that it's a great time to buy. I think that, you know, everyone loves Jeremiah 29:11. I love Jeremiah 29:7. He says, even though you're going into captivity, go buy land, plant,
Says the
marry,
mortgage guy.
have kids, make the community better because you're there. Because if they prosper, if you prosper, they will prosper. And so when I think about housing and the opportunity that people have right now, it's to really get into something. You know, the guidelines for mortgages are protecting you. They're not going to let you do anything really dumb. They will just tell you don't qualify right now, or you don't qualify for the amount that you're seeking.
Right.
So I encourage you to make the phone call, figure out how much you can afford, how much you can qualify for, and know that you're going to be inside of certain guardrails, and then see if there's inventory available inside of those guardrails, and then go full steam ahead. Because, you know, what do they say? The best time to plant a tree was like yesterday.
20 years
20 years ago.
20 years ago? Yeah, definitely.
The second best.
Yeah.
The second best was yesterday.
Today
That's
is
it.
right now.
Yeah.
Right now. Don't wait. And yeah, definitely get into, you know, we're still seeing equity growing inside of the housing market.
It's just not growing at 50%
Right.
in 2 years.
So before we ask, you know, how people can get a hold of you, and I'm not going to hold you to this. This is just going to be fun. Give me a year from now. Where do you think rates are going to be? Give me a number.
I'd love to see rates hovering like a 5.6 to 5.8 by this time.
The mortgage
next year.
rate.
Yeah.
Mortgage rate. Not the
30-year fixed.
Yep.
30-year fixed. 5.6
to 5.8.
5.6 to 5.8.
Yep.
You heard it here.
That's right.
All right. So how can somebody now? One of the things that I want to make sure you said, make that phone call. You're saying get pre-approval.
That's right.
If somebody wants to call you and get pre-approval, how do they go do that?
You can reach me directly at jromero@movementbank.com.
Phone number?
704-577-3028 or 704-918-LOAN.
There it is.
Loan.
Loan. Got that Google Voice number right when it came out.
Well, thanks for
that.
watching. Hope you learned a ton. And if you have any questions, you call that guy right there, Jonathan.
Subscribe.
And subscribe to the show. Thanks, man.
Yeah.
Thanks for watching.